Good afternoon. I'm Campbell McCrary. I'm a Vice President, Capital Markets at Amvest Capital here in New York. Welcome to the Amvest Capital Live webinar with SilverCrest Metals Inc. SilverCrest trades on the TSX as SIL and on the NYSE American as SILV. Hope you'll enjoy today's program. It'll also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in. We'll try and get to them in real time. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resources sector. Please note, it is important disclaimer, this call is for informational purposes only. We have with us today Chris Ritchie. Chris, going to make you presenter. If you'd share your screen and turn on your webcam. Chris is the president of SilverCrest. He's been a financial markets professional for more than 15 years in resource-based capital markets, including investment banking, marketing, corporate strategy, network, and risk management. During the past 8 years, Chris, through his work at National Bank and Canaccord Annuity, has been key financial advisor and partner to the previous and current SilverCrest teams through the development of Santa Elena, the sale of SilverCrest mines to First Majestic, and the 3 financings of SilverCrest Metals. This relationship provides strong continuity to his role today at the helm of SilverCrest itself. Following the formal presentation, again, members of Amvest will ask questions of management, and we do look forward to any questions that you'll send in. So with that, welcome to the show, Chris.
Thanks very much for having me, and thank you everyone for attending. Canadian Thanksgiving, anyone just recovering from that? Hope the turkey's wearing off. Want to start off with a few macro points. I mean, the investors in the resource space, as most people will know, are a very tiny sliver of the overall market. So we're always trying to get some new players into the space. The first slide here that we're showing, and most people have seen it before, again, is just looking at how big the last bull market has been for the rest of the market, you know, of the S&P and whatnot. We're in the biggest, largest bull run pretty much ever, right? And we'll contrast that with what we're seeing in the commodity cycle here. The second slide here, and it jumped up a little bit. The second slide here, where's the money gone? And again, we know the weighting, we've heard about the big 5 and whatnot. The money's been flowing to big and liquid companies on that standpoint. But in contrast, one of our big investors is named by a fellow by the name of Donald Smith, and he was trained by Benjamin Graham and looking at deep value. So this is the Goldman Sachs Commodity Index versus the S&P. And again, if you look back, that's about 50 years. The commodities have not been this cheap relative to the broader market in that time frame. If you look at the same Goldman Sachs Commodity Index versus the Dow Jones, that goes back to 1900. So now we're at 120 years seeing commodities have not been this cheap versus the broader market. And then again, you know, what are the cyclicals? What have they been doing? So as you can see, the money flows, you know, for the last 12 years or so have been just consistently pouring into the broader market. So again, another function just showing how beat up the cyclical sectors are. And again, active to passive, we all know the shift to ETFs and whatnot, what momentum has been doing, the government intervention into the markets, again, all going towards things that have been working. And again, that passive flow. Now, where also just another data point where the dot-com highs were about 12 years ago, or even 20 years ago, I should say, that we're back at these levels. So again, another data point just showing where the broader market is relative to commodities. I just got this chart a few weeks ago, and I thought this was a really interesting look at where we're at. And if you look at that 1 to 2% inflation range, and you can see that is where you see the highest PE multiples tend to be associated with the broader market. So here we are. The highest PE multiples occur with where we are today. So again, what I'm trying to show here is if we do see a shift and you do see inflation start to tick up, PE multiples come down, that could be a trigger of where money could be flowing into different places. So again, we're all looking at where we are in terms of this relative place in the cycle here. So another reason to suggest that commodities could get some fund flow if this trend changes. Another thing showing where inflation is today. In the bottom comment, the dollar volume of bonds quoted to yields less than zero. So 15 trillion held in bonds at negative rates. Now, again, where we are in terms of gold. So gold in general, so we're stripping out the other commodities. Gold versus the S&P. Now, again, this is about a 12-year chart. This last little big bull market we saw is just a blip relative to where other cycles have been. So it's just sort of maybe inning one, maybe inning two. And that's, you know, for people who are wondering, hey, is this rally over or is it just beginning? And silver specifically versus the S&P. Again, this last little move we've seen from 14 to 25 in the last, last run since March. Again, this is showing or suggesting at least that it is inning one or inning two. In the US, there's only about 1 to 2% of portfolio managers' benchmarks are in metals and mining. So again, people don't need to own the space. So you can see here that when most of this move up, the flows have been going into the physical commodity, not the stocks. And again, maybe the big money managers are, you know what, I'm just buy gold. And that's a way to meet my 1%. I don't need to think about it too much and buy stocks. And it's just showing that the equities really have not participated at all with this relative move in the gold price. So hopefully there is a catch up to come. Same chart. The money's been flowing into the GLD. So that's the gold backed ETF. And you can look from the red line there, the GDX and the GDXJ they've actually been seeing outflows in the last couple of years. So again, no one's been playing the equities yet. So again, speaks to the rally not being over. Same chart again, just showing that gold versus the junior miners. The junior miners have not caught up. Again, so this rally is suggesting the rally is still here to come. I'm going to show this chart and another chart, but if you look at the left axis there, 0.5% or so is the percentage of gold of global funds held. So the point here is what happens if that number turns into 1%, 2%, 3%? The actual amount flowing into the space could be huge. So again, just gives you a sense of how small the amount of money in this sector is. And if we do start to see inflation or more fund flow, then it could be quite interesting for a little while. And now we'll get into sort of what's been happening since COVID here. We've printed aggressively, and again, so has everyone. The Euro area is printing, Japan's printing, everybody's printing right now. And as you can see here, the velocity of money is coming down. So one of the quotes you'll see in our other slides is the Fed saying, we're not thinking about raising rates. We're not even thinking about raising rates. So they're going to keep printing until the velocity starts. Okay, so again, gives you a sense of how much longer we could go until it turns around. But when it does, it's going to get quite interesting here. And again, we'll show the correlation between money printing and money supply versus the gold price shortly here. I mean, same thing. The US is, we're right in the middle of one of the largest financial experiments ever with what's going on with the printing right now. And if anyone's read the book Deficit Myth talking about MMT, we're in the middle of MMT. Modern monetary theory. We are printing money to solve problems here, so we'll see how this plays out. This is one of the biggest drivers for a gold price, and it's negative rates. We did reference that there's $15 trillion in negative yielding bonds, and this is showing with the gold bars here, with the gold price and the red line, being the other way around. The red line being gold price and the yellow bars being negative rates. So the lower rates go, higher gold goes. So again, here we are at near zero rates right now. So we're still not really seeing that reflected accurately in the grand scheme of things. Same thing, the amount of negative yielding debt trickling higher. So there's your quote there about Jerome Powell talking about how long they're going to keep rates low. But here's where it gets interesting. This chart goes back over 100 years. And what you're seeing here is the relationship between money printing, or the value of money above ground, relative to the dollars printed. That's about as good as you get in terms of a relationship. So what you're seeing is that the money printing that we were just showing from those previous charts, the gold price and then the gold equities that haven't caught up with the gold price have not reflected the recent amount of printing. So we're just very much on the front end of this. This chart, top left, same thing. If you look at basically the correlation between dollars printed and where gold should be, you're getting something over $4,000 an ounce. So again, if you look at the bottom left, I showed the slide earlier about 0.5%. This is basically taking all the assets in the world and suggesting gold's, roughly 2.5%. So again, still really, really small amount of dollars held within this sector. And then GDP is where it is. So again, more printing, low rates. There really isn't anything to suggest that there's a need to increase interest rates where we are right now. And then again, some charts just to show quickly where we are in the potential cycle. So these charts show where the various previous cycles have gone. And you can see some numbers from the silver side, 1,000%, 30%, 60%, near 400, and then 350%. So again, nowhere near some of the previous bull runs, but yet the printing that we're seeing, low rates, and that correlation suggests that, again, we're in inning number 1 or 2 here. Same thing, and you look at the bottom left there, that tries to put in context where the current rally is relative to other rallies. And then specifically to the industry, you're seeing reserves are declining for the producers. So again, the actual supply coming out is on the decline. And these charts show that lag as well. One unique thing about mining is it takes about 7 to 8 years to bring a new mine online, and we've seen a 10-year lag in spending. So now that the price is starting to tick up, we're going to see a big lag in supply. So there's not going to be the same supply response, which could mean there's a nice little window where prices stay high. And again, here's your reserves declining and the supply response sort of lagging. If anything, COVID has actually taken supply offline. And again, just further showing that the 10 largest countries are declining in supply right now. So a really nice setup to get into what's going on in the market right now. And then when you look at the equities themselves here, again, look at the multiples. I mean, you're looking back about 15 years here. The price to cash flow of the actual equities themselves are near trough levels. So you're getting value at the same time as getting a really nice macro setup here. I'm sure you've all seen the gold to silver ratio, again, showing that silver relative to gold is very much near all-time highs. This is a bit of a dovetail into SilverCrest itself. If you look at the first red line there, what you're going to see is the all-in sustaining cost for the industry at about $7.50 per ounce. That was our average over the life of mine from our PEA that came out about a year and a half ago. The second red line that we threw in here, it's our estimate or guesstimate, if you like, of our all-in sustaining cost plus all of the capital that we plan on spending before getting into production. So it's inclusive of your production cost as well as your pre-production cost. No one else is going to give you those numbers. But again, it's an estimate, but it just gives you a sense that even if we do include that in our cost per ounce, we're still roughly in the 30th percentile of producers. So again, still in the very, very cheap space. Now, why I put that chart in there is to show that even if gold and silver don't go higher, or that we stay at these kind of levels for quite some time, we should still be in that bottom, either 8% or the bottom 30% based on how you want to look at it in terms of production costs. And same here, doing that for gold. I mean, if you converted all of our silver to gold and came up with costs from our economic study from May of 19, we'd be sub $400 per ounce. So again, still showing that we're in the bottom handful percentile here. Now SilverCrest itself, I know we don't have too much time. We're going to keep it to a really high level here. We are in Sonora, Mexico. And one of the best parts about our story that investors or potential investors can get their head wrapped around is that our CEO and our team found a mine that's 25 kilometers away from the current mine we'll talk about today. And they took it all the way from drilling all the way to production. And our CEO, Eric, he bought it for $5 million. I was on the sell side at the time helping to raise the capital. He built it on time and under budget. And again, this is the exact same strategy that we're going to go for today. So since then, we've added Pierre Baudouin. He's our COO. He built the largest mine in Canada. So again, adding more strength to the team that can build this thing, or will. We touched briefly on that PEA from a year and a half ago. As you can see there, that even if you're using the lower gold and silver, and again, just under $17 an ounce or $1,300 an ounce gold, we had an IRR of 78% and a payback of the project of under 1 year or 9 months. And that was only on a small portion of the property we've had. So since then, we've made some pretty major discoveries on the property, and our upcoming economic study that's hopefully coming out in December, that's going to include a bunch of the new data. Money, we've got 143 million US. We will need more capital. We need roughly 160 million US additional capital. We'll go through some of the details, but that's going to be roughly half equity, half debt. And if you think about it, it's probably going to be about 6 or 7% dilution. And the debt component at today's price with reasonable execution should probably be about 6 months payback, maybe even less. So again, pretty modest in the grand scheme of things. Drilling leverage. This has been the biggest part of our story to date. We have 8 rigs turning. And as you can see there in that row there talking about drilling leverage, 40% of our drill hits are above 350 grams per ton. We chose that number 350 because if you took all of the silver projects in the world and wanted to come up with a list of the top 20, 350 grams a ton gets you into the top 20. So again, 40% of our hits are above that. But just below that, you'll see that we have almost 600 drill intercepts over a kilo, 157 intercepts over 5 kilos, and 73 intercepts over 10 kilos. This is a past producing mine, and the average grade when it produced about 100 years ago was 3 kilos. So this is one of the highest silver mines, highest grade silver mines in the world, and that's a huge driver of the economics. And right below that gives you a sense of how efficient we've been with capital and how that grade has really helped us do that. So for every dollar we've spent, we've added about $9 of value. So again, that finding cost of $53 an ounce gold equivalent gives you a sense. If we've got $400 an ounce per gold cost, and you can find it for 53 cents or $53, but gold's near 2,000, that's a good use of our capital. Progressing towards a re-rate, we have our permits in hand. We've been operating the community for 15 years. The capital needs are quite modest. We've got a lot of working capital already sitting on the ground and about half a year's stockpile. So again, we're well on our way here. Just touching on quickly, we are in Sonora, Mexico. The reason I'm showing this map here is right near the top of the insert here, we show El Picacho. We just bought this property about a month ago. It's 85 kilometers away by highway. That's within trucking distance. Any success we might have here with new tons or new ounces, we can drive to our current property, and if and when the property gets up and running and the mill gets going, that's additional ore we can bring to that mill. So huge economies of scale potential that we hope to have. This was a $2.1 million purchase. So again, quite low cost relative to our other purchase prices. Las Chispas was $4 million and Santa Elena was $5 million. Some quick comments on the share structure. You can see by our shareholder register, most of these accounts are dedicated gold funds or resource funds. So hopefully people will see that as a fair amount of validation that people who know what they're doing have done a fair amount of work and can help give you some degree of confidence. Eric Sprott, he owns a healthy chunk, probably about 8.5 million shares. Gilder Gagnon owns about 9 million shares. So again, you're going to see a really tight shareholder register. Volume, we trade about $15 million per day. So again, most of the big funds are only now able to start looking at us. So hopefully we're entering into a new stage of investors that can take a peek. Just quickly on our share price performance over the last few years and on our financings. So again, most of our financings have been money-making events for our clients, as opposed to, here comes a financing and the retail investor gets left holding the bag. Most of our stocks have performed, or most of our financings have led to 10 to 30% performance after we've raised money. So again, that's something we want to keep in mind. for people who are just always aware of resource companies continuing to raise. So here's a way to look at value for us. Right now, if you looked at the senior producers in the space, they would have a free cash flow yield in the 5 to 8% range. And what that means is your after-tax free cash flow divided by your market cap. So for us, we're 1.1 billion US. And again, if you look at the bottom middle row, you see that 135 million per year. So that's over 10%, right? Again, we're 1.1 billion. But if you notice the top left, that's assuming $19 silver and $14.50 gold. So again, years 1 through 4 here, which is that middle column, if we are producing roughly 14 million ounces per year of silver equivalent, which is the number kind of 3/4 of the way down of that middle column, that's a number from the old economic study. We've optimized that. Our grade is actually improving since then. But if you use those metrics with today's pricing, you're going to get a number close to 20% free cash flow yield. So when I commented on progressing towards a re-rate, by Q3, Q4 2022, we hope to be in production. And if the investors holding the stock at that moment, are looking towards what that means for the stock, it doesn't mean we're necessarily going to re-rate to a 5 or 8% free cash flow yield. But hopefully it gets you at least halfway there. And if we don't get all the way there, it's one thing to suggest that the big senior producers with multiple assets and a lot of performance track record, they would be looking at us as a potential acquisition candidate. So in their portfolios, we would probably be trading at 5 or 8% free cash flow yield. So that's one of the ways you can look at the valuation of our company today and why it's an interesting opportunity. We talked about the cost previously and where we are. Again, $5 all-in sustaining cost on the silver side puts you in the bottom 5 or 6 percentile there. Now, growth. This is a huge part of our story that we've only scratched the surface here in terms of what we're looking for. Eric Fear, our CEO at the mine next door that he built, he grew the resources approximately 300% after we went into production. So again, what I want to show here is that we are still very much in the early days of what we're looking for. So again, 8 drill rigs turning. That's one of the largest drill programs in North America. Only 20 of a known 43 veins are going to be included in the upcoming study. And again, only 10 of 43 were included in all the numbers I've shown you so far. Bobby Vista, that is the highest grade vein we have on the property. It has the chance to be about 2 to 2.5 kilos, and that's on a cut and diluted basis in our mine plan. Now, we've only drilled 800 meters of 2 kilometers. So again, by halfway through next year, we hope to have drilled that off. Now again, more ounces, more grade. We can bring those ounces up front in the mine plan, and hopefully that means more ounces per year. So that means that free cash flow number could go even higher. Bobby Canora, El Muerto. People haven't heard us talk about the deep zone yet. I think we hope to have some news out in the next couple months on that. Now, this is the first time we've drilled to depth. And again, if we are successful there, it opens up the story to us having a whole parallel zone that opens up the number of veins we have to open up the blue sky. There'll be very little of that in our upcoming study, and we need to do a lot more work, but it just shows that blue sky potential is still quite significant here. Our drilling budget that we hope to have through construction is going to be about 75% of all of the money we've spent for drilling since we started the company. So again, everything that we're going to talk about in the upcoming feasibility study, if we can find half of the success rate we've had to date, that's a very significant growth potential that the shareholders we're going to get as we move towards that free cash flow profile. So it's a true two-pronged story. Keep growing and then get to that cash flow. I won't spend too much time on this. We've talked about the growth. I want to get to the Q&A pretty quickly here and just kind of quickly show the catalysts here. So again, we talked about the 8 drill rigs turning. we've already made a construction decision. We're already drilling, mining from the underground, building up stockpiles. We are going to have that feasibility study out at the end of the year. Next year, we hope to get the construction going in January or February. So it's full bore ahead. We do have a full quarantine site. Our CEO, his daughter, and her son, they're down in Mexico right now. We hope to get on site at Picacho. They're going to Picacho tomorrow. And we hope to have a very big growth profile coming from that asset. And again, nothing will be included in that in the upcoming feasibility study. And then again, in late 2022, we hope to be in production. So between now and then, investors are going to hopefully get a significant amount of growth and a significant amount of upside in the gold and silver price. So with that, I think it's probably time to turn it over for some questions, so you don't have to hear me ramble on here.
Sure. A few questions came in, but these first two kind of the same. In the context of the current $1.3 billion market cap on top of a 100 million ounce resource, albeit very high grade, and a PEA that shows 700 million upside NPV, it would probably be 1 billion plus at $1,924 gold, $24 silver. When will the next resource report be released, and do you anticipate that it will show a resource that justifies at least the current market cap? And then you can comment on a comment someone said he seemed a bit disappointed at the rate of news, and so I'll just let you address that.
Sure. So when you talk about valuation, to look at this, if you look down the middle column and you see that average annual EQ ounce produced, that's equivalent ounce produced. So shifting everything to silver or everything to gold. That 13.7 million ounces of silver, if we have been able to optimize that today to get it to roughly 15 million ounces once we're fully up and running, and again with the all-in sustaining cost at sub 5, so at $25 silver and $5 cost, that's $20 margins. So 15 million ounces a year approximately, and we'll see what the numbers come out with, times 20 million ounces, that's $300 million per year. And then if you take tax, roughly 25%, but again, the first few years less so because we're going to have tax pools, you're probably looking at about 225 million of free cash flow per year. So that means the first roughly 6 years of the production profile pays for the entire market cap. So if we're able to do better in terms of ounces, whether it's higher grade up front or the new property allows us to throw more ounces into the production profile, or silver goes to $30 or $35, you could have a situation where instead of being 6 years, maybe it's 5, maybe it's 4 years of production pay back the entire market cap. So the fact that only 10 of 43 veins are in the current study or 20 of 43 in the next study, not including the deep zone, not including the new property, you get a sense that there is still a lot above and beyond the value that we've currently surfaced. As it relates to number of ounces, we've been guiding the market between 85 and 95 million reserve ounces in the feasibility study. There's a thing called grade, and what that means is, you know, the grade that you need to have where you include it in the study or you don't. Sometimes if you have more narrow veins, you need to have higher grade in order to justify going to get it. We've increased the cutoff grade in the feasibility study. So we're going to be cutting out some ounces and tons from the original study, but we're going to be including some new ounces and tons that are high grade. So there's a reasonable chance that the grade profile of the ounces we do have could be a healthy amount higher. So again, that just speaks to the margins there. And in terms of sort of the, you know, number of ounces to justify it, again, I think that the number of years of production to pay for it hopefully gets you there. But again, hopefully if we've spent $9 of value to surface, for every $1 we've spent, we've added $9 of value. If we're going to drill 75% of what we've drilled so far since we started the company, if we're even half as successful it gives you a sense that, again, it's still very, very good dollars spent. In terms of the news flow, we've been pretty busy in terms of coming out with this feasibility study. We hope to have 3 news releases come out before that feasibility study in December. And this is data that will go into the feasibility study. So we will be quite busy. And then again, as we start the new year, the 8 drill rigs turning, and hopefully more if and when we get the permits at Picacho, we should be very aggressively putting out news through the entire 2021, 2022.
And then just potential hurdles between now and production and plans to mitigate. So that's a broad question, but I guess it'll tie into what you just said now.
Sure. I mean, like I said, our CEO's built 6 mines. Our COO built the largest mine in Canada. That was about 40 times bigger than this one. So it gives you a sense of a project management. We have our permits. We built in the community, so we know a lot of the local issues. The capital, again, we touched on needing about 160 million US. Again, 60 of that is hopefully for drilling. And then the payback period, as you'll see, if you're using 80 million roughly or so in debt, the payback period's in months. And from an equity standpoint, I mean, you're talking about 5, 6, 7% dilution. So that's something we'll be able to hopefully tackle kind of December, January, February. The 18-month construction time period, that's actually very short as far as mines go. And again, the growth we hope to have via the drill bit during that time is hopefully going to be enough to keep people quite excited or willing to hold it while you wait. And then again, it's coming out the other end to see what that free cash flow yield looks like and how many new ounces we found in that time frame to show what that re-rate and what that opportunity is for holders.
Okay. Gabe.
Thanks, Campbell. Thanks, Chris. So you mentioned a couple of times this 75% of total, is it cost or meters that you spent or that you've drilled? You mentioned 75%. Is that cost or meters?
We've drilled $80 million US since we started the company, and we've drilled 420,000 meters since we started the company. So we have a drill budget for the next 2 years that's going to be about 60 million. So again, kind of 3/4 of that amount. So again,
okay,
if we're guiding people 85 to 95 million reserve ounces, 120 to 125 resource ounces, inclusive of the reserve ounces, you get a flavor. If you want to pick a round number of 100 in the middle, if we found 100 million ounces with $80 million, how much are you going to find with 60? So it gives you a flavor. Sure.
Yeah, I mean, obviously you have to take into account cost increases and those types of things. What would you say to that?
Well, the Mexican peso's gone down, so that's one thing that's going to help. The cost of energy is going down. We are putting in a power line instead of diesel. That means our cost per kilowatt hour is going to go from roughly 28 cents to about 9 cents. Our underground development budget, like what we're seeing in terms of like just developing the mine itself, we've been within 1% of budget for the last 6 months. We'll see what's happening to some of the other costs. There will be other costs that definitely go up. I'm not just trying to cherry pick some of the ones going down. I haven't seen the final numbers, but it's relative to our cost profile. Hasn't been that significant, but also relative to the grade going up, that helps with the margins as well.
Okay, thanks. And then in terms of the 60 million, how do you, over the next 2 years, how do you break that down in terms of infill, exploration, geotech?
Yeah, I mean, right now the bulk is all focused on optimization. And what I mean by that is, for example, the average grade you'll see here in that middle column is 1 kilo silver equivalent for the first 4 years. That Bobby Vista vein, what I said, was probably between 2 and 2.5 kilos cut and diluted. So we're going to go after that. And if we can pull out some lower grade material from the mine plan and replace it with 2 to 2.5 kilo material, that could or should make a big impact to the mine plan. Well, that's a very tangible example of what we're going to be focused on. we want to make the first 1, 2, 3, 4, 5 years better. And then every time we find higher grade, we'll displace the lower grade material to future years. So that's why you're seeing 5 of the 8 rigs are going to be on that particular vein for the next 6-9 months. And then the deep zone, 3 of the 8 rigs are going to be on that. So we're back to resource growth. But if we start hitting on the high grade veins, we're going to back to do infill so that we can get into the mine plan quickly. So again, that 13.7 million, ounces per year of production, we're going to be trying to move that up pretty aggressively. I mean, I'm not promising anything. I don't want people to guide to that. But if we're able to get to 16, 17, 18 million ounces a year, pick your silver price, pick your cost number, then you can get some pretty interesting numbers. So that's the main focus.
Great.
I will say, sorry, Gabe, I will say one more thing. Picacho, we're high grade but low tons. Picacho's nearby. We've designed the mill to be able to be expanded. We could add about 30 to 40% throughput capabilities for about 20 or 30 million dollars. We don't have the tons to justify that today. So Picacho, the property that's within trucking distance, if we're successful there, that's additional tons we could be able to truck by. So that gives us the chance to, instead of going from 1250 tons a day to hopefully 1500 or 1750. So again, we don't have the tons to justify that today, but if you see wider veins, which those veins look like they are, we can add tons there, which again could increase the throughput and again give us another way in which to add to the annual production profile. So that's a fingers crossed, go forward type story. None of that will be in the upcoming feasibility study.
Okay, thank you. That's helpful. And then in terms of what's going to be in the upcoming feasibility study, I mean, apart from, and feel free to comment on things that won't be, but things that have my question is, what has changed since the PEA, flow sheet, processing CapEx, anything that's you think is material to the production profile?
Sure. So the CapEx in the PEA was 100 million US. We've been guiding people somewhere between 130 and 150 US. The major changes there were to the flow sheet. One of the things that I learned about a year ago was that the higher or the different grade of silver you have, you sometimes require a different process. So for example, the higher the silver we have specifically, we were going to lose recoveries. So we had to make some changes to the process sheet to handle those higher grades without losing the value of those higher grades. So we definitely put some money into that. We talked about the power line. That's maybe 10 to 13 million dollars of capital. But again, your cost per kilowatt hour going from 28 cents to about 9 or 10 cents, and then some cost for COVID. So there's your roughly 30 to 40 million of additional capital there. You will see some optimization. Again, that higher grade veins hopefully are going to go into the early years of the production profile to hopefully inch up those ounces per year. That's the main gist. Like I said, we've been guiding to 85 to 95 million reserve ounces. So losing some low grade tons and ounces because of that cutoff grade, but increasing some tons and ounces based on the new ounces that we found. Other than that, I would say those are the major amounts. So one thing you'll see when you look at the NPV on the feasibility study is it doesn't include the resource ounces. So for example, if we have 90 million ounces of reserves and 130 of resources, those 40 million additional ounces get no value in the mine plan. Now, you need to drill those at tighter spacing. So maybe you want to convert 60 or 70% or less or more into that mine plan, but you can look at the value of those particular ounces in hand and try to attribute something for those. And then again, what you're left with above and beyond that is the partially drilled veins that are amongst the 20 of the 43, the other 23 veins, the deeper zone plus the other property. So I think it's kind of your base case value plus the resource ounces plus the hit rate that we've been getting to on the drilling and what's that worth to investors.
Got it. Just one more before I pass on to Stu, that's okay. And just because you touched on it, so the question was around so validating your resource model as you develop the mine. Are we going to see Is that sort of what the move is here? And then in terms of the average grade of the stockpile that's built so far, are we going to be continually hearing news about the silver content of the stockpile build until the mill is constructed, or what are the plans around that?
Sure. So we have a 1,250 ton per day mill. That's what we're designing. If you do the math times 365 days a year, you get about 450,000 tons per year. So we need just under 500,000 tons per year to fill it. We currently have on surface 175,000 tons of low grade, and that was sitting there historically. That's at 225 grams a ton. So there's no mining costs, lower grade, but it's certainly useful. We've got about 45,000 tons that we've already mined. We pulled it up. We've been able to do metallurgy on that. That's over a kilo. So by the time we start the mill, we're going to have about half a year of throughput already on the surface. So the way we'd probably be smart or conservative is to say, let's assume we mine most of the low grade material in the first year so that we can just make sure the mill's working properly. We ramp up okay. We don't waste, the high grade while the recoveries are a little lower. So if people want to assume a 10 or 12 million ounce early year, that's fine by us. You can still, maybe you want to assume the costs go up a little bit per ounce, and you can still get a number that's going to be comfortably above the average free cash flow yield of the peer group. And then if we can get the mill working sooner or right away, then we're going to optimize it quickly. But in terms of guiding to people, we're going to assume that, hey, let's use that low grade material first out of the gates. But the changes in that process flow sheet are allowing us to process higher grade material. So you should see one news release come out before the feasibility study referring to the reconciliation. And what that means is the numbers we put out in the PEA for grade versus the numbers that we have now based on that infill drilling, that drilling that's got a way better risk profile to it. And so far, we've been seeing positive reconciliation. So again, it's been better than what we've been seeing so far. So again, that'll show up in the feasibility study, and you'll get an inkling for that in a press release before that.
Thanks, Chris.
No problem.
Stu?
Yeah, thanks for the presentation, Chris. Just on the permitting, so do you need any other permits, or everything's in good standing?
We have our operating permit, we have our explosives permit, we have our water permit. There's always some minor permits that you can only get as you get closer to production, and those are usually given by the same bodies that gave us the other permits. So yeah, most everything, all the major stuff we have is in hand.
That's good. And then the feasibility, I'm just wondering what the budget was, and if it was budgeted for more like a big company feasibility versus a junior, and whether that's going to appeal to some of the majors for down the track.
Sure. So again, we referenced the CapEx going from 100 to maybe 130 to 150. We've been very open with everyone about that, so I don't think there's any surprises there. Us talking about prioritizing the lower grade early on, same thing. We want to set the bar low. We don't need to have an overly aggressive hurdle rate coming out of the gates here when we do get into production in the back half of 2022. One of the things that did not slow down during COVID was the detailed engineering. Normally, when you come out with a feasibility study, you're about 30 or 40% complete. We hope to be about 70% complete. And also one factor of risk here that also comes to what people should expect. We hope to sign a contract with an EPC, like an engineering firm, to build the mill for us, and they give us a guaranteed price. If it goes above that price, they pay for it. And again, I referenced that our underground development is roughly 20% of that 130 to 150, and so far for the last 6-9 months, we've been within 1% of budget. So we have a pretty good idea of how the numbers are looking, not just because we've advanced so much, also because we've operated in the space. There's 2 other mining companies in the neighborhood. We're seeing a lot of real-time numbers here to go into that study. And again, we're trying to be conservative. There's really no reason for us to be overly aggressive.
Yeah. And then if you could touch or just quickly, which mines had management built, in the past? You mentioned the CEO had built 6 mines. Any in the area or in Mexico, if you could name them off?
Yeah, I mean, Santa Elena, and that's the one 25 kilometers away that Eric, our CEO, built. And our COO built Detour. And again, I referenced that's about 40 times the size. So from a production, like a project management standpoint, and knowing the social license in the local community, I think we've got about as good as a track record as possible in that category.
Yeah. And do you have any like Mexican shareholders? Do you on the register? Do you know of?
No major funds or pension funds or anything like that to our knowledge. I mean, most of our major shareholders, as you'll see, are the professional large resource guys that know the space.
Yeah. And then on the geology, are you confident that you have an adequate land package to encompass all of the silver system that you think exists here? And if not, are you addressing that?
Well, the Bobby Vista vein is probably only 150 to 200,000 tons. That's less than half of 1 year's throughput, but we think it could be 12 to 15 million ounces. So if you can put half a year's throughput for 12 to 15 million ounces, you don't need a lot of tons. So it's the grade that really drives the bus. And that new piece of land that we just found, some of the veins there are in the 4 to 8 meter wide range. A lot of the veins that we have on our property are 1 to 1.5 meters. So it might be lower grade, but you're going to get the tons. So that either means we're increasing the throughput or increasing the mine life. So kind of, if we're finding more ounces and more tons, the throughput could go up and the mine life goes up. If we're finding a lot of high grade, low tonnage ounces, we're going to move them right to the front of the mine plan and get that free cash flow sooner. So we just need more time.
Yeah. And then on the exploration expansion, like prior to drilling, what helps you guide, and it makes you feel confident that, there's this growth there? Like, is it geochemistry, geophysics, mapping? What helps you guide like prior to drilling?
Yeah, well, this was a past producing mine. A lot of what we drill under is old tunnels, old shafts, old stockpiles. I mean, the cutoff grade back in the day was 1 kilo. So anything below 1 kilo, they left behind. And a lot of these veins were faulted, meaning you're following a vein and then there was a vent that offset that vein by 10 meters. They never found it. For us to go find that with modern technology is pretty straightforward. And again, having drilled off 2 properties in the neighborhood, we've got a geological model. And the geological model used at Santa Elena, when applied to Las Chispas, led to the success. So again, now that we're hitting on these veins, a lot of the veins that we're drilling now were only partially drilled for that feasibility study. So just stepping out and going along the same veins should be the lowest risk ounces we have on the property. So I would say the next 6 to 9 months of drilling is probably the lowest risk additions we could have.
Yeah. And then are you saying at depth, the grade profile change? Are you seeing any examples of like porphyry rock systems or other geological systems below the veins?
Yeah, we haven't put out any news releases on a deep zone yet, but the fact that we're 3 of 8 veins are drilling on a deep system right now probably gives you a sense that we like what we see so far. And again, it's tons and ounces, and we're still in the learning time frame. But this is, if it's a parallel zone to depth, the 43 veins we have now, I won't say all of them, but I mean, there's a chance that some of them, maybe most, again, fingers crossed, offer a whole new set of targets for us. So again, it's the learning that we're doing on the go, plus the capital efficiency that we already have. Should, again, hopefully, if we're half as successful, then we'd be adding $5 of value for every dollar we spent. So again, that's going to be part of the 2021 story. And again, it sort of opens up that blue sky. So the value you look at will be the fees plus the resource ounces that haven't been converted, over yet, plus all the growth that we still hope to have.
Yeah, and then just on the production profile slide, which I guess drops off for you, is that why you have such a high budget for exploration once you're during construction to, you know,
Well,
keep a
it's time.
consistent annual profile?
Yes, it's time. I mean, I referenced that at Santa Elena, we grew production or grew the ounces by 300% after we went into production. So here was, we could have spent another 4 more years of drilling before we started to go into production. But we wanted to spend a small amount of capital and then expand the production profile if we find more tons. So it's a function of time. So one of our peers, Mag Silver, which is an amazing company, their first drill hole was 2003, right? So again, that was 17 years ago. Our first drill hole was 2016, and they're about 1 year ahead of us. So again, a big function here is, yep, we've got a really big drop off here, but I did reference the El Picacho, that by the time this starts to drop off, we've got about 7 years of drilling or 8 years of drilling to address it. So in 4 years, if we found, 100 million ounces or so, if we find another 100 million ounces in the next 7 years, we'll address this.
Yeah. And just one last question beforehand, Artie. Ever contemplated an open pit operation here with the vast number of veins? Or do you think maybe there is potential for open pit in the future?
Nothing at Las Chispas so far. I mean, those are pretty narrow veins, but at El Picacho, there definitely are open pit targets. So again, your ability to add tons quickly, that goes up really, really fast. So again, if you could find 2 million tons over there, that's not a hard number to get to when you've got wide veins or an open pit target. That's the equivalent of 500 tons a day for 10 years, right? So if you kind of put that on top of what we have now or what we might find at Las Chispas, that gives this production profile a chance to actually start to go to the upper end. But again, that's part of the growth profile. That's, the fingers crossed sort of scenario. But that's what El Picacho could do for us. And just if we kept going with the same success rate, you're going to be improving the upfront production profile, and all the lower grade will get pushed out. And then hopefully you're adding tons on top of that to get economies of scale.
Fair enough. Thanks for that, Artie.
So you mentioned like 20 plus veins there. I'm wondering what is the average time and money for you to develop those veins for the production, and like I'm wondering how far apart they are each other from them.
Sure. So about 3 veins are going to be about 75 million ounces in the feasibility study. So again, when we hit onto a high grade vein, you don't take a lot of tons to add a lot of ounces. So whenever we drill pretty methodically, and whenever we find something that's quite interesting, we'll throw a whole bunch of veins or a whole bunch of rigs at it. So again, the time is not that long to delineate this. So for example, Area 51 is sort of the meat and potatoes of the PEA. When we hit the big discovery hole, 8.5 kilos, we threw 4 rigs at it, and 4 months later, we had 40 million ounces of a kilo. So again, doesn't take very long once we find something. So that's going to be the strategy go forward. And again, our first drill hole was 2016. So it gives you a sense of time there. And these purple spheres, all these veins that are parallel to each other, that's about 150 meters apart. So when you're underground and you're drifting over to get to a different vein, in terms of the time and cost to go get those other ounces and tons, it's probably about 2 months and less than $1 million of underground development. So again, it's very tight together, which makes the cost much, much lower and the time much less.
Thank you. And you mentioned some flexibility on the feed grade of the designed mill. I'm wondering if the current stockpile that you are building is it ready to feed the mill when it is gonna be operational?
Yep, it's ready to feed the mill. But like I referenced, I mean, the average grade there is about 225 grams per ton. The average grade of our entire PEA was 725 grams a ton. So it's lower margin material, but again, it's already there. It's essentially free for us. So when you think about out of the gates, it's nice for de-risking. It's nice to make sure that the mill's working well. And if it takes a little while to ramp up, it's good to have. If we're able to ramp up more aggressively, then we'll put the high grade in sooner. So it's free for us. So it's just nice. It's a nice de-risking stockpile for us, and it also reduces the costs of underground development because we don't need to be as developed in the underground initially in order to safely start up production, knowing that you've got that much ore to put through. We think it's going to be around 6 or 7 months worth of ore that'll be ready to go when we start the mill.
Thank you, Campbell.
Sure. Stepping back a second, Chris, what would you tell a small investor who said, look, there are 5 less than 10 silver dominant plays to play this cycle now? I'm kind of torn between some of these bigger names and discovering some smaller names, and here you are. How should we look at the top 10, let's say, companies and what we're looking for as an investor, and what would bring why SilverCrest?
Yeah. So the average, see this one here, the average cost to produce an ounce of silver from the peer group is between $11 and $13 an ounce. Now again, we're comfortably at 24 today, so there's nice margin for most people, but we're in the 5 category. So for the small investor that's trying to figure out what they're looking for, let's do some quick math. Let's say silver goes to $15 an ounce. So again, where most of the peer group is making $2 or $3 of margin. So again, they might be producing 15, 20 million ounces a year, but if they're only making $3 a margin, that's not a pretty scene. If we're at 14 or 15 million ounces a year at $5, you're still looking at $10 of margin. So again, if we're 15 million ounces a year times 10, that's 150 million. You take your tax, maybe you're 115. You'd be at 10% free cash flow yield at $15 silver. And again, remember I referenced some of the big guys were at 5 to 8% free cash flow yields now. So we have way better defense in terms of what happens to our business model at lower commodity prices. Mm-hmm. Again, you look at the payback period here on the left, you can see it's at 7 months at $19 silver, right? And the IRR is 91%. So to me, it's way better defense, but the offense is also way better in terms of how aggressively we've been able to add ounces. And again, that free cash flow, or the potential free cash flow yield by the end of 2022 speaks to also the opportunity relative to the seniors.
The pullback of silver was brutal for the last few years for a lot of guys. So yeah, I definitely would concur with that. It's been a while since you released any drill results. When do you hope to have news?
Yeah, I mean, our last set of drill results was 1.3 meters wide at 73 kilos per ton. I think our next drill results will be on the deep zone. I think Eric's writing it right now. We will have another 1 or 2 more drill results for Bobby Vista that will be out most likely in November, early December. So that's 3 news releases on drilling prior to mid-December. So you should have 3 news releases in the next 6 weeks. So we're trying to keep up with everybody here.
Reached the top of our hour. I want to thank everyone for tuning in, and please we'll be queuing you for a little bit of feedback, just a few lines, really helpful for us. And I know Chris will appreciate it. Don't hold back. And follow SilverCrest, and for that matter, Invest Capital on usual places. Certainly LinkedIn is a good spot for both of us. With that, Chris, a closing statement, and we'll pick it up again soon.
Well, thanks everybody. And again, I think just looking at the grade here does a lot of the work for us. And this is high margin material that, again, it allows us to ride out all the volatility here, knowing that at $15 silver or $10 silver, we're still making free cash flow, or we should, relative to our peers. But again, coming out of production, if we don't re-rate close to where the seniors are, then I mean there's a M&A thesis that might be worth looking at for people. So again, above average defense and above average offense, and getting to production is done by a team that's done it before.
Excellent. Thank you very much. Good day, everyone.
Thanks.
Thanks everyone.